Welcome to The Explainer. Today, we're jumping right in to decode an earnings report from a company called Legence, and we're doing it to solve a classic, kind of confusing market puzzle. So let's start with that puzzle, right? It's one of those things that trips up even seasoned investors all the time. You look at a company's report, in this case, from Legence, their stock ticker is LGN, and on the surface, it looks like an absolute disaster. But then, the market does the complete opposite of what you'd expect. So on March 27th, 2026, Legends drops its earnings per share, the EPS. That's the big headline number that everyone latches onto. And they missed Wall Street's expectations by a hopping 60 cents per share. I mean, that's huge. Normally, that's a bright red flag, a clear signal to just sell, sell, sell. But that is not what happened. Not even close. Instead of the stock price tanking, it surged. It jumped over 7%. So what on earth is going on here? Well, the answer, as it often is, lies in digging just a little bit deeper, looking right past that headline and into the real story the company was telling. Okay, so let's dive in. The very first clue is all about the revenue. This was the big, shiny, positive story that Legends made sure investors saw right up front. I mean, literally, right at the top of their press release, way before they get to any of the messy profit numbers, they led with this one powerful fact. The company had just had its best sales quarter ever. And it's the scale of this growth that's so impressive. We're talking about a jump from around $548 million to almost $738 million. That's a 34.6% increase compared to the same time last year. Now that is the kind of growth that gets Wall Street to sit up and pay attention. But look, a big revenue number is great and all, but smart investors, they immediately ask the next logical question. Okay, where is this growth actually coming from? Which part of the business is on fire? And is it even sustainable? And luckily, the report gives us a really clear answer. Legend's business is basically split into two main parts. And as you can see, one of them is the absolute powerhouse here, making up more than 3/4 of all their sales. This right here, this is the engine. It's the segment that handles building these really complex systems for hot sectors. Think data centers and healthcare. And it grew by an incredible 44.4%. So boom, the first piece of our puzzle falls into place. Investors saw a company with massive, even accelerating growth in its most important business. All right, but this is where the story gets, well, confusing again. If revenue is hitting all-time highs, how in the world did the company actually lose money? Yeah, that's the crucial point. The official, by-the-book, bottom-line number was a net loss of almost $33 million. And this is the number that created that ugly headline we started with. So the key to unlocking this whole mystery is understanding that there are basically two different ways to look at profit. You've got the official number, called GAAP. It has a bunch of strict rules. And then you have the company's preferred number, non-GAAP, or the adjusted number. And they'll argue that that one gives you a much better feel for how the core business is really doing. Okay, so check this out. On the left, there's that official loss. By law, it has to include all sorts of stuff like non-cash accounting charges. A big one here was something called goodwill impairment, which is basically a fancy way of saying a company they bought in the past isn't worth what they thought it was. But then, look over on the right. The company presents its adjusted figure, where they add those weird items back in, and suddenly it's a totally different story. And this just illustrates the disconnect perfectly. The market, the smart money, they looked at this and basically said, okay, the official GAAP number looks ugly, but that's because of some one-time accounting quirks. The real profit engine of the business, that thing is humming along, spitting out $87 million. And it's growing. But believe it or not, even that isn't the full story. The real, number one reason the stock jumped is because Wall Street is, at its heart, a forward-looking machine. It's like it's always driving by looking through the windshield, not the rearview mirror. The past quarter, that's ancient history. What investors really care about is what's coming next. And this number, this was the number that really mattered in the entire report. Forget everything else for a second. This one figure told investors everything they needed to know about where Legence is heading. So that $3.7 billion, that's the company's backlog. The easiest way to think about it is it's guaranteed future revenue. These are signed, sealed, delivered contracts for work that's going to turn into real sales over the next few quarters, even years. And get this, that backlog grew by an enormous 49% from the year before.
And you better believe the company's CEO, Jeff Sproul, made sure everyone heard that loud and clear. He put the spotlight right on that record backlog, basically framing it as, hey, this isn't the finish line, this is the starting line for a whole new phase of growth.
Now, a huge backlog is awesome, but Legence actually went a step further. They gave an official forecast for the whole next year, what everyone on Wall Street calls giving guidance.
And here's the kicker. They didn't just meet what analysts were expecting. No, they raised their targets. They basically told the market, you think we're going to do well? We think we're going to do even better. They're forecasting more revenue and more of that adjusted profit for next year. I mean, that is the ultimate sign of confidence from a company.
Okay, so let's tie all these threads together. What does this whole Legends story actually teach us about what the market really cares about?
It really comes down to these four things. The stock jumped because the smart investors, they just ignored the scary headline. They saw an explosive growth story in the company's main business. They understood the crucial difference between a real operational profit and just an accounting loss. And most importantly, they saw that the future, that pipeline of backlog and guidance, was looking bigger and better than ever before. It's that simple. The future just outweighed the past.
Ultimately, this whole LGN report is just a perfect case study in how the market looks forward. It shows that stock prices are so often a bet on a company's promise, not just its past performance. And, that really leaves us with a big question to chew on. When we're looking at any company, what's the right balance to strike between the two?